Top 5 things one should know when applying for a mortgage. Hello, I'm Robert Niyazov, your trusted mortgage source. This video will give you a lot of practical and useful advice, so please watch it to the end and let's begin. So, thing number 1 is called assets. This is basically your money in the bank, money that you need for the transaction, money that you will give for the first deposit, and basically your investment in the purchase of the property. For example, if you want to buy a home for $500,000 and would like to get a mortgage of $450,000, this means a 10% down payment. That's money that you need to have in the bank, but that's not everything. What you really need to have is the combination of 3 things or the sum of 3 things, and I will break them down here now. So the down payment, which is what I said, the difference between your purchase price and the loan amount that you're applying for, the mortgage amount. Closing cost, this is the cost to to basically get the process done. This money goes to municipalities and banks, etc. And number 3 is reserves. Let's start with down payment. Down payment is, as I said, is money that you're putting, your investment in the house. This money has to be in the bank, or it can come in the form of gifts. But if it comes in the form of gifts from family members, it has to be well documented. They have to give you a check, personal check given to your personal name. You have to deposit in the bank. It has to clear, and they need to give you a gift letter. The second thing is the closing cost. This is some title cost. This is the cost that varies by municipality. It is a function of the purchase price and a loan amount, so it's different from case to case. However, in any transaction, it will be present. Large or small, it will be there. Let's just assume, for our example, it's going to be $10,000. I'm just making it up. So first, it was $500,000. You apply for $450,000. You need $50,000 as a down payment, and an additional $10,000 in closing cost. So in this example, person will need $60,000. Now, what is reserves? Reserves is money that people have after they already closed on their transaction. You see, the banks want to make sure that you're not sitting with no funds, that you have some money to live for a few months and when you get into the home. So that's reserves, and it could come from different sources like your pension money or some stock accounts. That concludes the first thing. Now on to the second one. So the second thing I want to talk to you about is the credit rating. Your credit rating is a key in a home buying process. And the credit rating basically goes traditionally from about 400 to 850. You want to make sure that your credit score starts with the number 7, okay? It's not excellent if it's between, let's say, 700 and 720, 740, but it's good enough, and you're going to get a better rate with this. Yes, your mortgage can be done with a score of, let's say, that has a 6 handle, 600, 650, but the mortgage rate will be higher and it will be harder to qualify for the mortgage. There's also a limited number of programs that you can actually qualify for because of the lower credit score. So more reasons to improve your credit score. And we actually recorded a video to this effect, more detailed video, how to improve your credit score. Please click this link, and you can also find the link below the video here. Okay, so that was number 2. Let's go to number 3. Number 3 is the income, okay? Calculating income, and let's break it down. So when people apply for a mortgage, the banks devise the system where they compare what's called your liabilities to your income. And liabilities are normally the credit that you already took before. Let's say your credit cards, your student loans, cars leased or financed, or other mortgages that you might have. Okay, anything that appears in your credit report, plus the expenses for your future home, like insurance and property taxes, and HOA, and by the way, means homeowner association fee if you're buying a condo, or there is a fee that their community charges. So all of this get together is called liabilities, and then it's compared to income, and it has to satisfy certain formulas. Now we come across situations where people obviously have enough income. Sometimes they may not have enough income, and we can see what we can do to help out in a certain situation. Plus, there are also programs available with alternative income where you, let's say, don't want to provide or can't provide tax returns or pay stubs or W-2s. Then, if you're self-employed, we can analyze the deposits that come into the business, and we can use that as income. If you're buying an investment property, we can use rental income for that, or proposed rental income for that property to qualify you, and we can document income this way. In situations where, let's say, we had a young couple come in a few months ago where a husband wanted to put a mortgage on his name, and we saw that the income was enough compared to his, what I called, liabilities. Then we said, okay, let's maybe add your wife's income. We added the wife's income, still wasn't working. So we said, okay, maybe you have a guarantor. And they were able to find a family member who came in and helped them out secure this loan. Number 4, the length of your employment, and most importantly, the stability of your employment, not to be confused with number 3, with income. So employment is your history of where you worked and in what capacity, what type of income were you getting. Was it self-employed income? Not the amount, but the type. Was it self-employed income, or you were working for a company? So there is a difference. So here, this factor is that we suggest not to change the jobs, too often. And if you did have, let's say you had an employment gap where you didn't work for a period of time, that could present a problem. There might be ways around it, they may not be, but if you have a stable 2-year history working in the same industry, or preferably in the same company, that's your best bet. If you're in the business for yourself, also there's a 2-year rule. If you have your company for 2 years or more, that's normally a minimum requirement. And please don't go from working for, let's say for someone, working for a company, to become self-employed and apply for a mortgage right away, because you will need, in most cases, wait 2 years. Lastly, number 5. Also, it's one of the top 5 in my opinion. Number 5 is finding the right mortgage professional. I think it's crucial, especially in this day and age where this process is so complex. You see, a good mortgage professional can help you structure a deal that otherwise would not have closed. Somebody comes with a very small down payment, and all the banks, let's say, are declining him, but there are programs for them. Okay, they can tell you, okay, quickly how to improve your credit history and not wait 2, 3, 4, 5 months. I'm not saying it's going to be in all the cases, but in certainly in many cases, a good mortgage professional can help you. I've noticed that the public does not appreciate and know how good the mortgage broker can be for them. So shop around for a mortgage broker. If you have any questions, you can always ask us. Please comment to the bottom of this video. Ask us questions. You can also contact us directly. Subscribe to our channel and suggest more content. We will be back very soon. And remember, always at R&J, we find a way. God bless you.